Good morning, Richard Calhoun, Creekside Realty, here to explain Silicon Valley real estate market, both geographically and graphically, and then the greater Bay Area, including 13 counties in Northern California. We'll come back and have an explanation of this slide at the end. This is what we're going to be talking about initially. Days of unsold inventory, a very key indicator, the ratio between supply and demand, what the typical long seller time on the market is before they accept an offer, the 75th percentile to be exact, the frequency of sellers taking a price reduction before they get an offer, the buyers coming in and over or under bidding the asking price, the frequency of overbidding, the appreciation since the last 9 months of 2015, and then the sold price, not just the median in the middle, but also the 10 percentile on the left and the 90 percentile on the right. So you have a sandwich of what's going on. Color code is basically red is a hot seller's market, blue is a cold buyer's market, white is a neutral marketplace. So here you're looking at days of unsold inventory. This is the key ratio. This shows you the different micro markets in the Silicon Valley, which is Clara, San Mateo County, and Alameda counties. And you can see that the only area that's in the deep blue is the expensive areas in San Mateo County. The bulk of Silicon Valley is in a seller's marketplace, and that's defined as anything, well, the red is gradiented from 7 days on the market to 42 days. And then blue is 78 to 145. Below 7 is saturated red. Between 42 and 78 is neutral with white. So here is the DUI over time. You can see that we're pretty red over on the right-hand column, which is the current data. You can see right at the beginning part of the year, we were a lot paler. And even last year, this goes back for 6 months. It allows you to see DUI over time and how it improved. Now we're moving on to something that's sort of not as accurate or as meaningful statistically or economically, but it's sort of a good benchmark for consumers. What is the long typical seller taking to sell their property? It's the 75th percentile. So you look at all the sellers, how long they're taking to sell. Where is it that 75% of the sellers sell quicker than the time listed? So basically, most of Silicon Valley, 75% of the sellers are selling in under 2 weeks. There's an awful lot of areas in Alameda County that are 10, a week and a half. That might get them through 2 weekends. It might be just a little time before the weekend, and then time after the weekend. Campbell, Santa Clara County is basically at 2 weeks even. That is a pretty fast marketplace and is something we've been seeing for some time now. This is the frequency of price reductions. This is how common is sellers reducing their asking price before their offer comes in. And you can see it's not very common. To give you some idea, I go saturated red at 17.5. I go saturated red at 5% of the sellers taking a reduction. It becomes white at 17.5, and then it immediately goes to blue. And the reason there's no neutral on this is it's a very sensitive scale. So you can see that here's your deep red at 5. You get up here to 17 and you can see your pale. And then it's very unusual for us to take more than 30% of the sellers to take any sort of price reduction before the offer comes in. So it's just a very condensed indicator. I could shorten up the 17.5 and make a gap for the white, but I just decided to not have any white gap. This is the magnitude of overbidding. So this is you sum up all the bids, overbids and underbids that buyers come in, and what is the average ratio. And you can see that the hottest area, believe it or not, is the city of Alameda and also the city of Oakland. And then you also have, in general, Santa Clara County is there, but not as much, maybe about 105%, so 5% overbidding. And San Mateo County has less, somewhere around 3 or 4% overbidding. Obviously, there's some fluctuation on there, but it clearly shows you where the hot spots are and, as far as overbidding magnitude. Here's the frequency of overbidding. So how common is overbidding? If a buyer goes in and offers $1,000 over asking price, that counts as an overbid, as well as 10,000 overbid. You can see it's the more affordable areas that are indicating a hotter seller's marketplace. Here's the appreciation since the last 9 months of 2015. And I picked that time frame. I was trying to get a whole year, but I also wanted price stability, so it didn't matter how many homes were sold in the lower period of time versus the highest. And those 9 months were pretty price stable, and that's why I selected them. But you can see the expensive areas, for the most part, have had less appreciation. And that turns out to be basically along the lines of who's ever having the most appreciation recently is typically the one that had the most appreciation overall. Again, there is an exception here. The expensive areas in San Mateo County, it's got one of the highest higher appreciation rates at 75% since 2015, but right now it's not doing so well, and you would see that when later on when we compare it to the appreciation for 2020. So blue is lower appreciation, red is higher appreciation. Here's your price range, and again, you can see the blue area is sort of on the southeast as you travel away from the San Mateo, Santa Clara County border, which basically turns out to be sort of the epicenter of real estate for the most part locally. And you have three numbers here. The number on the left is the cheapest 10% of homes you'd expect. The middle number in the middle is the median, and the number on the right is the highest 90% that you'd expect in that given geographical area. And one thing I want to just point out real quick is it's important to pick your micro market areas quickly. I know some people do it based on zip code, and mine's based on zip code, but I've grouped several zip codes together. And the reason for that is if you select just one zip code, then you have a lot more statistical fluctuation and you really can't tell what the market's doing. So I grouped as many zip codes that are similar homes, similar price, and geographically contiguous to each other together that I could find to try to get stability and yet have some sort of reasonable understanding of what was going on in that marketplace. Now we're shifting gears a little bit and we're looking at the ask price reductions. These are the reductions in the list price that the seller may take before they get an offer. So it doesn't take into consideration the reduction that comes in with the offer. It's just what the seller did trying to trigger that offer to come in. Basically, every line on here is either a month or weekly distribution of that ratio. The blue dotted line here is the worst week we had in the recent past, and that was just November 27th of last year. The best we ever had was Valentine's Day of 2022, where basically no sellers were taking a price reduction, at least not as many as 2.5%, because at 2.5% of the sellers, you were still at 100%, and that's the red line up here. I will point out we had a worse year down here, and this is just a rough approximation, and I do need to go back and get that data. I believe it was February of 2008, where we were way down here. So we do have worse, but this gives you an idea. If you're up in this area, you're a red hot seller's marketplace. If you're down in this area, you're sort of an ice cold buyer's marketplace. And when you're transitioning between the two, you're sort of in a neutral marketplace. We have the blue down arrow indicating the market decrease from the previous week. The red up arrow is an improvement. When they're both on here, it's indicating a plateau. This red is shaded because it's really a down marketplace, but I wanted to show the red arrow. So now we'll just step through and go a month at a time. There's 11 months. 10 months, 9 months. You can see how rapidly it came down. Then it went up, then it plateaued, then it slowly came down, and now it's going to turn around and start working its way up 4 months ago, 3 months ago. Now we go to weeks, 12 weeks, 11 weeks, 10 weeks, and you can see it was all close together. Now we jumped up. Now we're going to have another jump, and right now, most of these are pretty close together, but finally, when we get to it this last week, I'm going to say we jumped up again right there. And that's going into next week. Going into next week's normally a plateau because there's only 3 out of 35 data points changed. The purple is the current week data that actually ended on Wednesday instead of Friday. The green line ended on Friday night, midnight. You know, basically that gives you an idea. The concept here, and I don't know of anyone else that tracks this list price distribution. The reason it's so important is you don't have to wait for escrows to close to see if sellers are taking more price reductions. So you can see expectations versus the reality based on where this graph is. The closer you get up to this corner, the closer perception of what the market is, the closer it is to reality. The further down here it is, people's perception is stronger than the marketplace. So it gives you an indication of which way the market's going. Now we're going over back to my more long-term index, which requires sale price. So you have to wait for escrows to close. So there's a 5-week delay. Same concept, different orientation. So now as you go up and to the right, the market's improving. As you go down to the left, the market's getting worse. The blue line here is the worst week we've ever had in the last 25 years. And that was November 30th of 2001, shortly after the World Trade Center, before we started getting the nesting boom. So I'll just step through and let people see what happened there. You can see it came down, another big step down, another one, smaller step down. Now you're sort of at a plateau. You're going down again. And now we're going to turn around and start going back up. So again, with the issue here is this is what the market was doing 5 weeks previous to the actual date, because we don't know the offers that just got accepted this past week. We won't know their sale price for 5 weeks. So this current line is based on closings, which is that lag time of about 5 weeks. Now, what we're looking at is Silicon Valley. So the three counties all in a giant blender, and we're looking at where it normally is. So the blue line up here is the coolest you'd expect out of the last 10 years. The median is the middle number where you'd actually expect the market to be. And the red line right on underneath the purple, and you can see it there if you look very carefully, is the hottest marketplace you'd expect. With inventory, low amount of inventory is typically a hot marketplace. So what this is really saying is we're having essentially tied for the worst inventory you'd expect. Now, it isn't the record low because I'm using the 10 percentile for stability purposes. So there is going to be 1 year lower, which explains why all through 2021 and early into 2022, inventory was below the lowest you'd expect it to be. Right now, we're tied for the lowest you'd expect. So it turns out to be about the second lowest number of year, where you'd expect inventory to be here, and that's pretty significant. So you'd expect inventory to be around 2,600 homes for sale, and instead we're down here somewhere around 1,650. That is a huge discrepancy. And with that, you'd expect a very strong marketplace. But on the flip side of the equation is the demand, and that's the number of offers accepted. Same concept, but now a lot of offers is a strong marketplace. So this is the hottest you'd expect, the typical. This is the least number of offers, and we're just barely above the least number of offers you'd expect to have. So that's pretty significant, especially when you consider that going into that is the pandemic shutdown that we had at this time of the year. Remember, from March 17th through May 1st, we weren't even able to show property. So when you're looking back over 5 weeks, we're basically still in that shutdown, and it took about 30 days. So by about June, we'd be back on track. So this data by July would be back on track. So we're still in the pandemic, and yet we're basically just above the lowest number of offers you'd expect. And that is sort of a concern that at least I have. Because days on sold inventory is the ratio between the two, you can see now you're between the hottest marketplace you'd expect in the middle. And it's, hard to really judge scale, but that's real estate's very cyclic, which is why this pattern seems to repeat every year. And it's also why you need to know what time of year is. What do you expect the DUI to be on July 1st? That number is different than where you expect it to be on April the 1st, and it's different than where you expect it to be on October the 1st. So you have to have some reference on where you expect it to be, and that's what the thin red, gray, and blue lines are supposed to be doing. So this would tend to indicate that we have a strong marketplace, stronger than where you'd expect it to be, which indicates that the number of offers coming in is not as low as the low inventory, and that's exactly what we saw. Here's time on the marketplace. So this is what the 75th percentile seller is doing, and right there is completely normal. From the seller time on the marketplace, it's exactly where they'd expect it to be. They're not spending more or less time on the marketplace. And again, that's the 75th percentile, not the 5th percentile, not the median, but the long typical seller. How long is it taking them to sell their property? And right now, it's way under 3 weeks, because 3 weeks would be 21 days. It's just barely over 2 weeks, and that's for the Silicon Valley, the three counties all in a blender. Now we're looking at the 10% of the sellers that took the largest price reduction. How much of a reduction did they take? And basically, they took a 10% reduction. So 10% of the sellers took a 10% price reduction, and that's the most you'd expect it to be because you're right on the blue. Up here, typical is only an 8% price reduction. The hottest you've ever did is only about 7 3/4. So you can see the hot and the typical are very close together. The cool is down quite a bit, but even a 10% price reduction isn't that huge. And when you think about it, we've gone from higher prices to lower prices, and just emotionally, sellers usually want to sell their house at the peak and for the highest in the neighborhood. And that means that they price it high, and only when the reality of the market sets in do they lower the price. So their expectations are higher than the market, which is why the price reductions are so large. Now, this is the average. So instead of just looking at the extreme, and 10% may sound like a very extreme, but remember that it's not all that common that you have price reductions of more than 17, 20, 25%. The slowest marketplace is 30%. So you have to get pretty far out on that extreme to have some sort of a reasonable benchmark. So the average now is we're right there with the sellers taking sort of the biggest price reductions. But what is that? It's about 3/4 of 1%, or maybe even 2/3 of 1%. You're way less than 1%. Here's a 99 would be a 1% reduction. Typically, you're somewhere around a third of a percent reduction. And on a hot marketplace, you're still typically taking somewhere around a tenth or maybe 15th of a percent of a price reduction. So price reductions, when you look at it, it's pretty small. And that's because the vast majority of the sellers do not reduce their asking price. This is the frequency of asking price reductions. So this is just how common it is. And you can see back here when we were at the end of the year, when the market was slow, only a third of the sellers were taking a price reduction. Conversely, when the market was at its peak in early 2022, only about 2.5% of the sellers were taking a price reduction. So you can see it's a fairly small range, and what you really need to do is sort of come back here and sort of look at what the typical range is, and the typical range is somewhere from about 7.5% to 20%. That's even being a little generous, and that's sort of how I come up with the 17.5%, as I sort of estimated what this was. Right now we're sort of at the coolest that we came down just in the last couple of weeks, because normally the market's turning around and going worse where more sellers are taking price reductions, but here we're still improving. So here's the magnitude of overbidding. And so now what you're doing is you're looking at the median. What is the midpoint? And right now it's at 2%. You'd expect it to be 4%. So buyers are only overbidding by half as much. This is the buyer that's right in the middle. This is the average to give you some idea. You'd expect the average to be higher, and it is. It's a little bit above 6%. So the average buyer, when you average everybody up, including the underbids, they're about 6.25% over the seller's asking price, but the median point is only 2%. So there's a lot of people that are just going a little bit over, but then there's those buyers that come in and pay 25%. There was one that I saw that was 263%, so almost 3 times the seller's original asking price. And it was actually an expensive property. It was a property that came on the market at something like 5.6 million that sold for 15 million. And that's just from memory, but I'm pretty close, so I'm not that far off. The frequency of overbidding, so again, the gray line up here is where you'd expect it to be. So the frequency, you'd expect it to be almost 3/4 of the buyers are overbidding the seller's asking price. Right now, we're down here somewhere around 67%. So still pretty aggressive. 2/3 of the sellers are getting there more than their asking price. A far cry from where we were just 4 months ago, when only 33% or 32% of the sellers were getting over their asking price. So it's basically doubled in just basically 3 or 4 months. This now is the long-term sale price. The purple line, the blue thin line is just sort of a freehand best slope line in there. So that's typical appreciation. When the current data is below that, you'd expect to have appreciation. When it's above, you'd expect depreciation. Now, clearly it doesn't happen immediately because you were expecting depreciation based on this one benchmark in 2021, but yet early in 2022, we had a big run up, and now we've had the correction, and now we're coming back up to where you'd expect it to be. And that's based on real estate goes up at a typical clip, and it goes up in the long run at sort of a steady pace. Yes, there's times when you're above the line, and there's times when you're below the line. You'll also notice you're always below the line at the end of the year, and that has to do with the geographical mix of the marketplace. It turns out the more expensive areas tend to shut down more for the end of the year holidays than the more affordable areas. If the more affordable areas become a greater percentage of the total marketplace, that has a drop in the median price. So this is not reflecting property values. It's almost more reflecting market mix. And I should bring back in the market mix slide, and maybe I'll do that. So now what we're doing is we're looking at the 3 components that make up Silicon Valley, which are Santa Clara, San Mateo, and Alameda counties. So Santa Clara is the blue, San Mateo is the orange, and Alameda is the gray. And you can see Santa Clara and Alameda are very similar, and San Mateo is a much lower because it's a much smaller county. But the real takeaway, in my opinion, is just look at the inventory. You're down here at 600, and you're basically halfway between the second and third quarter. So you're middle of second quarter, and you go back and we had roughly the same number in the 2021. Alameda County had less. Santa Clara County had about a little bit more because it's up here. But in general, you were way more. And if you look at it long term, at this time of the year, you'd be expecting something like 1,400 homes on the market for both Santa Clara County and Alameda County in rough numbers. And right now you're only about 600. So the reduction in inventory in those two counties is far more, where if you look at San Mateo County, maybe you'd expect 500 based on 14, maybe you'd expect 375 based on 15, but somewhere right around 400. And where are we? We're right around 400. So San Mateo County has almost normal inventory. So it's the lack of inventory in Alameda County and Santa Clara County that's making the combined lack of inventory. Here's your offers accepted. So here you can see the slowdown. It's not as dramatic as inventory. And you can see Santa Clara is doing a little bit better than Alameda County, because Alameda County is down here, and historically Alameda County is slightly higher than Santa Clara. So there's been a reversal of roles, and Santa Clara is now doing better, but it's still, you can see the drop, because typically you'd be up here somewhere around 1,100, and instead where we're at now is about close to 900. So you're probably 20% below the number of offers you'd expect to have. Here's your days on unsold inventory. It's the ratio. The big takeaway in my mind is you can see that San Mateo County is typically, historically, the quickest county. The DUI is the lowest. Then we get into the pandemic, and then it basically flipped over and became the highest. Yes, there's some fluctuation here, but again, now that we're settling out, it's clearly higher than Santa Clara County and Alameda County. And Alameda County and Santa Clara County, when you just go back, you're at some of the lowest DUI that you'd expect. Yes, 2020 and 2021 were lower, but after that, you're pretty much some of the lowest numbers, fastest paced marketplaces. Here's looking at the 75th percentile of the sellers. They're very closer together to here, which is a little surprising. There's not more separation between Alameda County and San Mateo County based on DUI, and that's why it's nice to have a lot of different benchmarks. Here's the magnitude of the typical price reduction between the three counties. So San Mateo County is taking the biggest price reduction, and Alameda County is taking the least. So it's sort of interesting that even though Santa Clara County is outperforming as far as the volume of business, Alameda County is outperforming on the reductions of asking price. Here's the overbids, and this is where Alameda County really starts to shine. The magnitude of overbidding is way up in Alameda compared to the other two counties. You're up here about 109.5%. Santa Clara County, you're probably at 104.5%. So there's a 5% price drop between the two. And when you're talking about numbers less than 10%, that's pretty significant. San Mateo comes in at somewhere around 3.75% overbid on average. Frequency of overbidding, the same ratio. Alameda County up here, almost at 3/4 of the sellers getting more than their asking price. Santa Clara just below 2/3 of the sellers, and San Mateo County just below 60%. So pretty strong overall compared to what people might be perceiving, but again, not typically where you would be at this time of the year. Here's sold price over time. This is log. I'm a fan of log, but what it's allowing you to do is take the current price, draw a straight line back through, and you can see San Mateo County is very close to where they were price-wise of 2021 after the pandemic, way above where we were at the end of the year, but they basically back to the level of 2021. Santa Clara County is outperforming their 2021 price performance. So San Mateo County has given up more relative to shortly after the announcement of pandemic. And Alameda County is sort of like San Mateo County and basically right at the level of where they were in 2021. And that's allows you potentially fairly easily in areas where there's not a lot of current comps to go back and pick a time frame and at least get in the ballpark of what market value is most likely for the property you're considering. Here is the same graph on regular paper for people that prefer analog paper. And here's appreciation since the last 9 months of 2015. You can see that the lines are pretty close together, but you can see that Santa Clara County, the blue line on the far right, is outperforming the other two counties. So Santa Clara County has seen more appreciation. Now we're looking at the actual table of numbers for people that want to look at numbers. We're looking at the number of new listings. A lot of people follow new listings. I don't think it's that meaningful. The total number of inventory is far more important than the new listings that are coming on the marketplace. What's noteworthy here, there's again close to a 20% shift, which is pretty remarkable because I'm using a 5-week moving average, so 80% of the data stays the same. But when when you go back and look into this, like I did, because I was a little surprised by this data, 5 weeks ago, we were basically the Friday before Easter, and every holiday negatively impacts real estate. So we just got rid of a week that was the week before Easter when you'd expect very little new listings to come on the marketplace. We replaced it with the current week, which is going to be more because you're sort of at the peak season and you're also not at a holiday week. And when you take those two factors together, you have somewhere around a 15-17% increase in the number of new listings for 1 week. And that's, well, for the past 5 weeks based on this past Friday. So I look at the data on Friday night at midnight, I go back 5 weeks and how many new listings were there. To me, the number of active listings is far more important, and you can see the number of active listings is basically unchanged. So your new listings jumped up 20% and would catch anybody's attention. Your total level of inventory available for a buyer to purchase is essentially unchanged. You know, if you want to look at combined 16.5% to 3%. So it's not zero, but it's a fairly significant discrepancy. And between the two, which is more meaningful, in my opinion, the total active inventory that's available for a buyer to buy is far more important than the number of new listings, whether you determine that based on the number of new listings in 1 week or 5 weeks. I use 5 weeks for stability. And you can see how unstable that is. You can imagine what it's like if you're going Easter to the week after Easter, how dramatically shifting it would be. Now you have the number of offers accepted, basically relatively unchanged. DUI relatively unchanged, but pretty aggressive at 26.5 overall. Now we jump down to closings. You can see the number of closings is not that high. Santa Clara County and Alameda County are essentially identical, with Alameda County being about a third of the volume, maybe a little bit more than a third of the volume. Median days on the marketplace, average days on the market, 75th percentile. Your overbids down here, the appreciation since 2015, and then I got the appreciation since 2020. So here you can see that San Mateo County has appreciated the least since 2020 and not the least overall, which is a little unusual, but that means that between 2020 and 2015, Alameda County was not doing as well because it appreciated more based on a higher price, and yet overall it's got only a little bit higher price appreciation. And then the 10 percentile median and 90 percentile for the 3 counties. This now is not comparing exactly apples and apples, because I'm looking at May data, which is not available until 35 days after May 1st, and clearly we're not there yet, but it's sort of a forward-looking to some degree. But look at inventory, 631. You can't find a number anywhere close to that. The lowest number you can find here, at least if I did my search correctly, is 760 in the pandemic. So we're coming out of the pandemic when we couldn't show property and no one was listing property, and we have less inventory now than we did then. Then you come down to days on sold inventory, and it's pretty aggressive at 24. Yes, there's going to be some years that are close, like 2017, and is that going to be the only one? That's the only one. So and then 2021. So we were out of the pandemic with no inventory, and the buyers came out first. So 2021 had the lower DUI, and then 2017 had a slightly higher DUI. But now come down and look at the number of sales, 902. The pandemic, you were at 991. So we're selling 10% fewer homes now in the past 5 weeks than the 5 weeks ending in May, which is pretty amazing when you start thinking about it. Similarly with closings are lagging behind. So you were still closing pandemic transactions earlier, so it was lower. But to me, it's the lack of sales, and we'll focus on that later. So this is comparing June 5th data basically with data from May 14th. So you can see we're not completely apples and apples. Here is the apples and apples comparison for April, if someone wants to compare on where we were, and it was basically the same analysis, so I'll skip it. Here's the record low sales that I'm talking about. Yes, the pandemic is lower, which is why I blew them. The blue is over here because those are record low for cool buyers marketplace. Here are the actual numbers. The reason I took them out is I want the percentages here to be calculated on normal years. I don't want want to include the pandemic. So what this is saying is we're only selling 76% of our previous record low in the last 25 years, or the last 10 years. We're only selling 81% of our record low in the past 25 years. So that gives you an idea of not only are we at a record low number of sales, we're at a record low number of sales by a long shot. I'm not hearing other people talk about the lack of offers. That's huge. It's basically like a bull marketplace in the stock market with very low volume. They get discounted. The bull market in real estate that we're currently having should be discounted to some degree based on the complete lack of volume. Here's now looking at the three components. The purple is the inventory. So you can see you have only 60% of the inventory you'd expect. The offers are coming in a little bit higher. Maybe it's 70% of the offers you'd expect. Because the number of offers expected is a higher percentage than the number of inventory, that gives you the DUI at a lower than 100% and probably somewhere right around 90%. You'd expect it to be right on the horizontal 100% line because you're comparing every year to the last 10 years. Here's a summary of what we went over. So now you can pick your geographical area and figure out your market conditions, come over, pick your price point, and figure out what your market conditions are. Now we're shifting from Silicon Valley and into the greater Bay Area. So we've been focused on slides 2 through 82 was talking exclusively about Santa Clara, San Mateo, and Alameda County. Now in slides 84 through 97, we're going to bring in 4 more regions. This is what I call Silicon Valley. This I call the cities, North Bay, Central Valley, and Central Coast. Here's the data. So we're doing in the reverse order, starting with the data and going graphs. Here's your graphs, the active inventory that you'd expect. And again, you can see that the North Bay and Central Valley are way down. They probably have had the most reduction because it's right with Silicon Valley. So we're all three now are the same, but historically the Central Valley and North Bay are almost at 5,000 homes on the marketplace. You know, even in the lower years there was like 4,500, and now you're only around 1,750. That's huge in my book. Number of offers accepted, the trend is not the same, but not as dramatic. You're probably somewhere normally up here around 2,500. Now you're somewhere just shy of 2,000 for the most part. Here's your days on sold inventory. You can see that Santa Clara County is typically way below. It's sort of getting mixed in with the North Bay and the Central Valley. So the North Bay, Central Valley, and Silicon Valley are all fairly aggressive. Your Central Coast and your cities are cooler. But when I say cooler, they're still somewhere around 45, 50 days on sold inventory, which is a strong, you know, not a real strong, but favoring the seller over the buyer. Here's your time on the marketplace, the 75th percentile. You can see Santa Clara County or Silicon Valley is the quickest at under 20 days, somewhere around 15, followed by the cities area at somewhere around 30. And then the other three regions are very close together around 35, 38. Here's the median days on market. I don't particularly like this data point, but I put it in there for completeness. This is the seller's 10% reduction. So you can see here that the Central Coast and the cities, or 10% of the sellers, are actually taking 20% ask price reductions. That's huge. The other three regions are all up here at 90%. That's clearly an indication that something's going on, and you can see it's been a fairly recent shift in those areas and fairly dramatic when you start looking at it, because here you are somewhere since April 1st, you were still up here, and the cities was way up here at only taking a 10% price reduction. So the cities in the last 45 days has doubled the amount of their price reductions. This is the average amount of price reductions. You can see Central Coast and the cities is the greatest number. And again, this is the average, so it's much nicer sounding number, somewhere around 98, 8.25. So basically a 1 3/4% price reduction. So less than a 2% price reduction by the typical seller or the average seller. Here's the magnitude of overbidding. So this is almost contradictory. So even though sellers in San Francisco are taking big reductions on their asking price, they're getting huge overbids. They're getting 6%. So they're getting as much overbidding as Silicon Valley. And again, that's one of the reasons you like to have as many data points, is so you can get in there and really understand what's going on. Central Coast is consistently doing the least well. Here's the median number. This is the midpoint on overbids. So you can see that 3 of the regions are right at 100%, which is sort of where you'd expect, which is why I use the average on overbid versus the median typically. And here you can see the cities and Silicon Valley doing the best at somewhere around 3.5% overbidding on median. The smallest amount of overbids, so this is the buyers that come in and knock down the price the most. You can see Central Coast is around a 7% reduction. The other 4 are pretty well clustered together around a 4%, 4.5% price reduction on their bids. This is the largest amount of overbid. So this is the buyers that are going overbidding. You can see the cities is outperforming everybody close to about 122%. So 22% overbid. Silicon Valley is right at 20%. So 90%, 10% of the sellers in Silicon Valley right now are bidding 20% or more over the seller's asking price. The other 3 regions are much more subdued at somewhere between 5 and 10% overbidding for the 90 percentile buyer. This is the frequency of overbidding. How common is overbidding? You can see for Silicon Valley, it's about 2/3 of the sellers getting above their asking price. The cities is pretty close at around 64%. Then you have North Bay and the Central Valley coming in just over 50%. And the Central Coast is doing the least well, just over 40% of the sellers getting more than their asking price. This is the appreciation. You can see that San Francisco, the cities, is really pulled down from the others. The other 4 regions are grouped fairly close together, which is typically what you'd expect. I believe this is directly related to the pandemic and shifts in workplace habits. And with that, we're finished. So first, let me do an explanation of what this is. We were doing week 19. The green is what I call my root URL. That's where you get to the archive on YouTube. You add in 2023, the year, and you get to the live presentation Saturday morning at 9 a.m. If you add in H for handout, the year 2023, the month 05, the day 13, you get the handout. It's posted. I didn't pay attention. It's probably about 53 slides. I try to get it up about 15 minutes early, and I did meet that today. And any specific episode. And again, I'm Richard Calhoun, Creekside Realty, working with buyers and sellers since 1981. And do I have any questions? Not seeing any unmuted mics. I'll call it quits. Have a nice week, everybody. Thanks for dropping in. Bye now.